Bond yields just hit their highest level in over 15 years, since 2008. Here are three things to think about as interest rates have moved higher. Hi, my name is Eric Blattner. I'm with Divvy Wealth Management. Thanks for watching. First, before we get too far, if you enjoy the content that we provide, the best ways to follow along are to go over to divvywealth.com. That's DIVVI wealth.com and sign up for our blog there. Or you can subscribe to the YouTube channel here. Now, that being said, we're recording this on Thursday, August 17th. And everywhere you look, there's news stories about interest rates on the rise and the 10-year Treasury yield, in particular, being at its highest level since 2008, about 15 years. And it made me think of some of the implications for investors. And I really had, I guess, three questions that I wanted to discuss today. Do higher interest rates make bonds a better diversifier? So, for most of the last decade, interest rates have been historically low, in some cases close to 0%. And now that a 10-year treasury is above 4%, shorter term rates are even higher in certain situations. Um, does that benefit bonds? And generally speaking, it should provide a better starting point for fixed income investors, where the majority of the return is going to come from the coupon or the interest rate. So that's a good thing. The second piece is, when we think about fixed income, we don't want bonds and stocks to be moving the same direction. So in certain environments where stocks struggle, we would like bonds to provide some diversification benefit and do well in those environments. So, of course, all bonds come in a lot of different shapes and sizes. Here's a chart that shows historical correlation, at least from the beginning of 2000 through the end of July 2023, how different categories of bonds have correlated with the S&P 500. So on one end of the spectrum, you have U.S. Treasuries with a negative correlation, and then things like aggregate bonds. Those are basically investment grade, corporate, treasury, mortgage backed, things of that nature. And tips all have a relatively low correlation. And then when you start to get into corporate bonds, whether it be investment grade bonds, those are going to be from really credible issuers like Johnson and Johnson, or high yield issuers who perhaps don't have the same level of cash flow to cover their interest expense. Those are considered riskier. And the corporate bonds generally move a little bit more, at least directionally, in lockstep with stocks. So when we think about providing diversification benefit, we generally tend to focus on the left side of this chart, or of that chart, the U.S. Treasuries, investment grade, and tips. And with the goal being to provide some type of a diversification benefit when equity risk, when the equities in our portfolio might be more challenged. So now that the 10-year yield is over 4%, we wanted to essentially go back and look at recent history and try to understand what that has meant for some of those investors. And so this chart here shows really that time frame, the beginning of 2000 through today. And the orange shaded areas, those periods were characterized by a 10-year yield between 4 and 5%. So that green line shows the 10-year treasury yield. The orange shaded areas will show you the periods in which that interest rate was between 4 and 5%. So we're primarily looking at the early 2000s. And anytime you look at historical periods for context, I think it's always helpful to remember some of the different situations, some of the different events that were really characterizing that time period. And the early 2000s were characterized, at least from an investor standpoint, by the tech bubble bursting, and the NASDAQ lost almost 80% of its value from peak to trough during the early 2000s. You also had 9/11. There was geopolitical conflict. There were all sorts of issues that make it unique compared to today. And then you fast forward a few years, 2006, 2007, you had the global financial crisis starting to take shape, with subprime mortgages starting to show cracks. And ultimately, you had Bear Stearns collapsing, and um, a lot of different events unfolded that led to another really nasty bear market from 2007 through 2009. where stocks, again, looking at the S&P 500, fell around 55 or 56%. So two really nasty bear markets in this period, in this orange shaded area that I referenced a minute ago. So just keep that in mind, I guess, as we look at some of the characteristics from those different periods. So I already mentioned, do higher yields make bonds a better diversifier? Generally speaking, I think the data would suggest the answer there is yes. This chart shows, again, those 3-year correlations between treasury bonds, a treasury bond index, and the S&P 500. And we're really only looking at the starting points from those periods where interest rates were between 4 and 5%. When I say interest rates, I'm talking about the 10-year treasury yield. So from those starting points, what was the correlation between treasuries and stocks? Every single time it was negative. Generally speaking, we want a negative or an inverse relationship between these two pieces of the portfolio, or it adds a diversification benefit when the correlation there is lower. If the bonds that we own move in the same direction as the stocks, then that doesn't help us a whole lot in those more challenging environments. We might lose less, but we're probably not going to flip the script and actually have that piece of the portfolio make money in those periods of stress. So hopefully that makes sense. So that seems to check the box. The second question that I had was really, what's the right price to pay for stocks when interest rates are at this level? And I think when I say price, I'm speaking specifically around a multiple. In this case, I'm just going to use the price to earnings multiple to keep things simple. And there are a couple of different rules of thumb or heuristics that might be helpful when thinking about a fair, quote unquote, fair price for stocks, which is, again, very subjective. You ask a dozen different investors what's a fair price, you're probably going to get at least a dozen different answers. So keep that in mind. Again, these are just rules of thumb. One is going to be 20 minus the rate of inflation. And this simply states that you take the current rate of inflation from the number 20, and that is roughly a fair multiple to pay for stocks. It's been around for a long time. And so currently, year over year, inflation through July 31st of 2023 is at 3.2%. So let's just round down, call it 3, which would mean that a fair multiple, a fair PE multiple to pay for stocks is around 17 times. Now, when we look at PE multiples, we can either look at the earnings, the historical earnings, or we can use projected earnings. In this case, we'll do both. So current PE multiple on the S&P 500 is about 20 times. Looking at last year's earnings, so you would pay 20 times last year's earnings to buy the whole basket of the S&P 500 right now. Or 25 times using the historical. Or if you use expected earnings, these are coming from consensus analyst estimates, it would be closer to about 20 times for the whole basket of stocks, 20 times those expected earnings. However you slice it, it's a little bit higher than that rule of thumb. The 20 minus the rate of inflation would suggest as a fair price, which all that means is through that lens, stocks might be a little expensive. A second way to think about it is looking at it in the interest rate regime. And these are certainly not the only two ways, but they're two ways. And historically speaking, as interest rates have moved higher, investors have been willing to pay less and less for a dollar in earnings. And as interest rates move lower, investors have been willing to pay more and more for that dollar of earnings. If you think back to the mid 2000 teens when interest rates were really low, folks were generally encouraged to take more risk to try to earn some type of a return. So that's kind of how that relationship works. And again, going back and looking at the period just from 2000 through today, the median PE multiple using forward earnings is about 16 times. So again, comparing that to today's number of 20, it would give you the appearance that stocks are a little bit expensive. So that leads me to my third question. Can stocks still perform from here? And I think the resounding answer is maybe. It generally depends, at least in my opinion. I think it depends a lot on your time frame. And the punchline here, or the spoiler alert, is that long-term optimists odds historically have been on your side, in your favor, and no different when interest rates are between 4 and 5%. So if you look back at Again, these historical periods going back to 2000, interest rates between 4 and 5%. The 1 year returns for the S&P 500 from those starting points have been all over the board. There's actually the gap between the highest return and the lowest return is 66%. So it's huge, a huge window. You could drive a truck through it, which means short-term returns, or I guess it doesn't mean this, but I think it supports the idea that short-term returns are notoriously difficult to predict. If you start to zoom out a little bit further, 10 and 15-year returns, I think we start to see a little bit of a more favorable situation for stock investors. Yes, there have been some periods in here when returns were disappointing. The 2000s in general were a very poor decade for stock investors. But still, the median return from each of these stock starting points, fast forward 15 years, if you look at a 15-year holding period, the median return for an investor in the S&P 500 was about 9% per year, which, again, compared to a lot of alternatives, is pretty darn good. So to summarize, interest rates are high. They're higher today than they have been really at any point in the last 15 years. That might have some implications that folks should think about as they're considering how they invest going forward, whether it means reevaluating the fixed income that they own and whether or not or how they want that to behave relative to stocks. Is the diversification benefit going to be there? Secondarily, pay attention to the multiples and the risks that you're taking. We mentioned the averages for the S&P 500. Of course, there are multiples that are all over the board. Some are much lower, some are much higher. Might be a good opportunity to revisit some of the risks and prices you're paying for those stocks. And then lastly, keep a proper time horizon in mind. So generally, we like to talk about aligning long-term goals with long-term portfolios, short-term goals, short-term portfolios, to help keep folks focused on things that matter. So hopefully you find this interesting. If you have any questions, please reach out. Again, don't forget to follow along at divywealth.com or subscribe here. Thanks for watching.